The GOP Tax Cuts and Jobs Act cleared the full House and advanced out of the Senate Finance Committee on Thursday, but those two big steps forward would be better news if the bill weren't standing right near the edge of a cliff. 5 Republican senators, 3 more than enough to force a major rewrite, have now gone on the record with serious criticism of the legislation. Even worse, the changes they want have conflicting aims. Some want to make the bill more generous, others aim to reduce its cost, and one, Maine Senator Susan Collins, wants the GOP to keep its hands off Obamacare's individual mandate and the $318 billion pot of money that would materialize if they eliminate the unpopular mandate. Bottom line, it looks increasingly doubtful that Republicans will be able to achieve their top priority of a permanent 20% corporate tax rate, and there may be another shoe to drop. Republicans' narrow Senate majority could get even smaller, with polls suggesting scandal-hit GOP nominee Roy Moore could lose a December 12 special election in deep red Alabama. That would leave the GOP with just a single vote to spare. Among those raising concern about the bill's fiscal impact are Senators Bob Corker of Tennessee and Jeff Flake of Arizona, both of whom have butted heads with President Trump and have decided not to seek re-election. "We're looking globally at the whole thing and trying to do what we can to make it more fiscally palatable," Corker told Politico on Thursday. Flake told Time that the bill is full of tax cuts that are made temporary to hide their true cost. "We can do tax reform in ways that will grow the economy, but we can't just ignore the debt and deficit." So far, investors don't seem to be unduly concerned about what appear to be the tax bill's increasingly rocky prospects. After surging 187 points on Thursday, thanks to better-than-expected earnings news from Walmart, WMT, and Cisco Systems, CSCO, the Dow Jones Industrial Average gave back more than half those gains on the stock market today. While Wall Street may not have gotten everything it wanted in the all-important Senate bill, it got much more than most investment strategists have thought possible, with a permanent 20% corporate tax rate starting in 2019. Yet now it's becoming clear that the deal was too good to be true, with the key question being how much worse it will get. As GOP tax writers aim to satisfy the bill's intra-party critics, it's looking increasingly likely that the Senate will follow the House's approach to taxing the past earnings which multinationals like Apple, AAPL, and Google parent Alphabet, Google, have accumulated overseas to avoid being taxed in the U.S. The Senate would apply a 10% tax on cash and 5% on illiquid assets, raising $185 billion. The House's 14% tax on cash and 7% on illiquid assets would raise $293 billion. Apple held $252 billion in cash overseas at the end of its fiscal fourth quarter. Still, there's no reason to think the change will free up nearly enough cash to satisfy the bill's critics, and Republicans appear to have used all the tricks up their sleeves to make the Senate bill comply with budget rules allowing for passage with just 50 votes. Among those looking for more generosity from the tax bill are Wisconsin's Johnson, who issued a statement on Wednesday declaring that he would oppose any bill that creates a competitive imbalance between pass-through businesses and major corporations. The most alarming part of Johnson's statement to GOP leaders may be that he's opposed not only to the way the Senate treats sole proprietorships, partnerships and other businesses whose income is taxed via individual returns, but he even rejected the House approach. Official estimates from the Joint Committee on Taxation say that pass-through businesses get a $225 billion tax cut in the Senate plan, while the House gives such businesses a $597 billion tax cut. Meanwhile, Rubio tweeted out early on Thursday, "Disrespectful and wrong to argue that lower-income workers don't pay taxes. #child tax credit should apply to payroll tax, not just income tax." Rubio's point is that working-class parents who only pay payroll taxes may not benefit much from the Senate's doubling of the child tax credit to $2,000, since the refundable portion would remain at $1,000 and grow only with inflation thereafter. On Wednesday, the GOP's Collins unloaded on the changes to the bill that Republican tax writers revealed late Tuesday, calling it a major concern that individual tax cuts would sunset after 2025, while corporate tax cuts would be made permanent. In general, Republicans say that a permanent corporate rate cut is needed to give businesses enough certainty to make long-term investments. Collins also blasted the move to attach the repeal of the individual mandate to the tax bill, warning that the effect for some middle-income households will be to cancel out their tax cut. Killing the mandate is expected to raise premiums as relatively young and healthy people shed their coverage, which will sting for families earning more than 400% of the poverty level that aren't eligible for Obamacare subsidies. Yet without the cash shaken loose by eliminating the individual mandate, more than $600 billion in the second decade, making a 20% corporate tax rate permanent would entail a total tax hike on individuals of more than $1 trillion in the decade starting 2028 to meet the Senate's deficit neutrality rule. On Friday, Alaska Senator Lisa Murkowski also expressed concern about repealing the individual mandate. She said that her vote on the tax bill would be contingent on passing a bipartisan bill known as Alexander Murray to stabilize the insurance exchanges first. Yet there's virtually no chance of Democrats supporting that bill now. Everything changed once President Trump cut off funding for cost-sharing subsidies paid to insurers to compensate them for limiting deductibles and total medical costs for low-income beneficiaries. Restoring those subsidies now, as Alexander Murray would do, could result in a $200 billion cut in total spending on Obamacare insurance subsidies, the Congressional Budget Office says.